Hi, I'm Thomas, and welcome back to Business Strategy. Today's lecture is External Environment, the Five Forces Model. In analyzing our external environment, the Five Forces Model is a five-part analysis that we evaluate component by component. Threat of entry, the possibility of new competitors entering the industry. Bargaining power of suppliers, how much power, how much influence our suppliers have in our industry. The bargaining power of buyers, our customers, what is their position, how much power do they have in our industry. The possibility of substitute products, how strong is that possibility to create a threat for us to lose market share. And finally, rivalry. What is the situation existing among the competitive set in our industry? How strong is the rivalry among competitors in the industry in which we operate? We're going to look at these each in more detail. First, let's talk about the industry life cycle. Any industry goes through a four-stage life cycle: introduction, growth, maturity, and decline. Depending on where a company is in the life cycle, then the five forces are going to change, and factors that might have been important in the past won't be important now, or weren't important in the past are important now. Factors that were weak might become strong, factors that were strong might become weak, etc. So it's important to keep in mind that the five forces model, as we analyze a company, as we analyze an industry, an important factor to keep in mind is where is this company, where is this industry, in more general terms, the industry, in its life cycle stage. So let's look at the determinants of the main determinants or main factors for analysis in each of our five forces model components. First, the determinants for threat of entry. Capital requirement. The higher the capital amount required to get into the industry, the higher the barrier and the more protection for our company, the company that we're analyzing. If it's a capital-intensive industry, it's hard to get in, and that is good for the existing company in the industry. If the capital requirement is low, then it's easy to get into the industry, and it's a situation in which we don't have a good barrier. We have a low barrier to entry. Strength of existing brands and trademarks. If we have a strong brand, we have a strong identity, or trademarks which protect our ideas and our products, then that is a high barrier to entry that protects us. If, on the other hand, we don't have strong brand loyalty, or we're a generic product, or we don't have trademarks that protect our ideas and our products, low barrier to entry, and we're under a greater threat of new competition. The level of government regulation in an industry is an important factor. High government regulation or intensive government regulation creates a higher barrier to entry and protects our company from new entrants. If there's low or no government regulation, it's easier for companies to get into the industry, and that is a low barrier. That's an additional threat for our company. Number 4, the fourth point, customer loyalty and switching costs. If it is difficult, if there are costs involved in switching from our product to another product on the part of our customer, or even if the costs aren't high, but there is a tendency for our customers to be highly loyal to us, then that is protection, high barrier to entry. If, on the other hand, we don't have customer loyalty, it's not costly for customers to switch from our product to another, that's a low barrier and a higher threat situation. And finally, product similarity. The more differentiation, the higher the barrier to entry. If it's a product that doesn't have a lot of differentiation, somebody can come in and they're basically making the same thing that we're making or providing the same service we're providing. That's a low barrier. The more differentiated our product, the higher the barrier to entry. The less differentiation in our product, the lower barrier to entry, and the greater threat to our company. Next, looking at the power of suppliers. What are the determinants relating to supplier power? First, the number of suppliers. The more suppliers we have to choose from, the better position we're in. We have more negotiating ability. If one supplier doesn't want to provide us with good service, good pricing, we can go to another supplier. If the number of suppliers is low, then we're in a weaker position because we have fewer options for negotiation. And the suppliers generally know how many suppliers exist that we have the option to work with. So the lower that number, the weaker our position because we're in a weaker bargaining position, and that's a greater threat for us. Switching costs. If it is easy for us to switch, just like in analyzing the other factors, we'll see some overlap here. We'll see switching costs come up more than once in our analysis. In supplier power, the idea is if we can switch from one supplier to another easily, then that's good for us. That gives us bargaining power, and that's a low threat. But if it's costly for us to switch from one provider to another, then we are in a high threat situation. We don't have a good bargaining position. The potential for forward integration is a possible threat. Forward integration, we'll learn more about the value chain later in the course. Forward integration means that a supplier might decide to move forward in the value chain and begin to produce the product. And that's our field. That's what we are doing. So if there is low or no potential for our suppliers to begin to do what we are doing, then that's a high barrier and we're in a good position. We have protection. That's a low threat. If, on the other hand, a supplier has the opportunity to move forward in the value chain and take over our role, then that supplier would become our competitor. And that's a threat that we need to consider. So the greater possibility of forward integration, the greater the possibility of our supplier moving forward in the value chain and beginning to do what we do, the higher the threat to us as a company. Options for substitutes. What options do we have to substitute? Not just change supplier, but actually change the raw material, change whatever product or perhaps service that we're acquiring from our supplier. If we can substitute and use a different product, then we have a stronger position and a lower threat. If we don't have an option for substitutes, we have to use a particular product or service, then we're in a lower strength bargaining position and a higher threat scenario. And finally, scarcity of supplier resources. The scarcer or rarer the resources of the supplier are, then the weaker we are because we're relying on that supplier. The more abundant those resources are, then we have more options, we have a better bargaining position, and we're in a lower threat scenario. Now going to buyers, the determinants relating to buyer power. First, the number of buyers. Now we're switching the position. We can think about the buyer as the inverse of the supplier. We're between the supplier and the buyer. If our buyer is performing the 5 forces analysis, then they look at us as a supplier. So there is a continuum here where we can see when we are evaluating our supplier, well, they're evaluating us as a buyer. When we're evaluating our buyer, they evaluate us as a supplier. So in our buyer determinants, first the number of buyers. The more buyers that we have, the better position we're in. If we can't get a good price from one buyer, we can go to another customer and work out a transaction with them that is at terms that we feel are fair. If we only have one buyer or 2 buyers, we have a small number of buyers, we're in a weak position because we don't have any other option. If the buyer doesn't want to deal with us, we don't have other buyers to go to ask for better terms. So the higher the number of buyers, the stronger our position and the lower the threat. Switching costs, now not from our perspective, from our buyer's perspective instead. The more costly it is, the less convenient it is for our buyers to switch from our product to another, the stronger position we have and the lower the threat. If the switching costs for our buyers are low or non-existent in some cases, then that puts us in a higher threat situation. We have a weaker position. The potential for backward integration, again thinking about the continuum. When we're looking at our supplier, we're concerned about them moving forward in the value chain to become our competitor. When we're looking at our buyer, we are evaluating the possibility of them moving backward in the value chain and becoming our competitor. So when we're selling a product to a buyer, what is the possibility that they could decide and then execute the move to work back and do what we are doing for them and become our competitor? The greater that potential, the higher the threat to us, and the lower that potential, the lower the threat and the stronger our position is. Next, options for substitutes. Again, from our buyer's perspective, what other options do they have? Can they, not looking at what other suppliers they can go to replace us, but what other options do they have to not use our product or service, use a substitute? The more options they have, the weaker our position is, and if they have few or no options, then we have a strong position in a low threat scenario. And finally, buyer price sensitivity. The lower the buyer is, the lower the sensitivity of the buyer to pricing, the stronger we are in our competitive position, because they're not going to be price shopping. They're not going to be looking at other options. Why would a buyer not be price sensitive? Well, no company is 100% price insensitive, but companies have a trade-off. We could look at two factors, service and price. And a company might be more focused on service, or we could also describe that as quality, and less focused on price. If they feel good about the service, the quality we're providing, then they're less sensitive to the pricing. If, on the other hand, their focus is the pricing, then our service, our quality isn't as important, and we have a situation that's a greater threat for us. This buyer isn't committed. There's not something that they see that we're providing that others can't. They're focused on price, and there's a greater threat that they'll look at other options. The determinants for substitutes. Here we have a short list. First, price and quality of substitutes. What is the possibility of a product replacing ours? Well, the pricing and the quality of those other options determines how great of a threat the substitute is. If the pricing is low and or the quality is high, then that threat is higher. The higher the pricing, the lower the quality, on the other hand, means that that threat is lower. And switching costs. The cost to switch from our product to another creates a way we can evaluate the level of threat relating to substitutes. The lower the switching cost, the higher the threat. The higher the switching cost, the lower the threat. And then finally, rivalry, the determinants to evaluate rivalry, the existing competition. We looked at the beginning of new entrants and the threat of that factor. Now we're looking at existing rivalry, existing competition in our industry. What is the number of competitors? The more companies we're competing against, the higher that level of threat is. The smaller the number of competitors, the fewer companies that we're competing against. That doesn't necessarily mean it's a low threat, but we can describe that as lower threat. The lower the number of competitors, the lower the rivalry threat is to us. Exit barriers. If it's easy to get out of an industry, that's good for us, because if times get tough, companies will get out more quickly. Whereas if exit barriers are high, an example of a high exit barrier is when there's a lot of fixed costs in an industry. Once a company has made that high fixed cost investment, they don't want to just close up and leave the industry. They're going to end up losing a lot of money because they're going to lose that fixed cost investment that they made to get in. So if it's difficult to get out, and one way to evaluate that is a high fixed cost industry. If exit is difficult, that creates a greater threat for us, because when times get tough, instead of companies looking and evaluating this as an unattractive investment opportunity and leaving, they've already made a big investment and they don't want to lose that investment. They have a big sunk cost, so they'll stay in. And having a situation with high exit barriers keeps the rivals in the industry and creates a greater threat for us. Next is industry growth. The higher the industry growth, the lower the threat. with the existing rivalry scenario or portfolio, the more growth there is, the more opportunity there is for everybody. If we're in a stable or a declining industry, then that increases the threat, because there either isn't any growth or there's a decline in the total market, and somebody is going to lose out. Product differentiation means that we don't all sell the same product. Even if we have a number of rivals in the industry, if everybody's product is a bit different, and specifically looking at our analysis, if our product is different, has differentiation factors from the other products, that's good for us. That gives us a position of strength and a lower threat position relating to rivalry. If there is no product differentiation, if everybody's product is the same, then that gives us a high threat, a weak position in our analysis of rivalry. Next is relative size, relative to the existing competitors in our industry. The bigger we are, generally, the stronger our position, and the lower the threat is for us relative to our rivals. Evaluating our rivalry is one of the 5 forces. Now, sometimes a company gets big, they get lazy, they forget about how they were successful in the first place, or they assume they can just keep doing the same thing and continue to be successful, and that leads to declining performance, maybe even failure. But looking at our existing situation as it is, in comparison to other businesses in our industry, if we're a big player, then we're in a strong position and our threat level is low. On the other hand, if we're a small player relative to the competition, then our position is weak and our threat level is high. And finally, customer loyalty. If our customers are loyal to us, and we can look at this as a customer being loyal is someone who is probably more focused on quality and particular features of a product or service than they are on the price. The brand is what attracts them, not so much the price. Given a reasonable price, they might be willing to pay more for our product than they are willing to pay for other products. They're loyal to us compared to the rivals in our industry. So the more customer loyalty we have, the stronger our position, the lower the threat. If, on the other hand, customers tend to be very price sensitive, this varies from industry to industry, and sometimes from brand to brand or company to company within an industry. If companies are very price sensitive and are not loyal to a particular brand, particular features of a product, particular quality level, then that increases the level of threat for a company, for a customer, to leave us and go to one of the competitors in our industry. That concludes the external environment 5 forces analysis, and in our next lecture we're going to continue with the external environment and look at additional factors relating to that component of our strategic analysis. I look forward to seeing you in class for our case analysis, where we're going to apply these concepts, the external environment 5 forces model, to a real case evaluation.